another episode of With SONAR. We are here. We're back in the office after we had an amazing event last week at Future of Supply Chain in Cleveland, Ohio, where you got to hear from two of our special guests, Charles of Halliburton and, of course, Andrew at L'Oreal, where we talked about what is the value of multimodal data, but also what's the power of index-linked contracts. Very exciting. And Tony, you got to join me for our discussion with L'Oreal.
Yeah, I mean, that one was great. Listening to Andrew, a lot of powerful insights on how they're leveraging data to just make advances, right? I mean, he talked about it, like service is like their number one thing, like component, and right?
Yeah.
Like,
very important.
They basically rate it like service, cost, and then like the ESG initiatives. Like that kind of falls third. But I mean, you think about it.
Makes sense.
Makes sense overall, right?
Yeah.
How do they make money? By products getting on the shelves. Well, guess what?
It's not on the shelf, nobody can buy it.
Exactly. So that's where the service component came in.
Yes.
And I think that was a part he highlighted great and mentioned. And then you kind of trial this pilot, the index-linked contracts, and see, hey, we might pay you a premium to what the market says, but we expect the elite service.
The thing, too, that it makes a lot of sense in their world, too, when you bring up service, right? You know, products have to get on the shelf. In their world, right, they are in the cosmetics world. It's fairly high margin.
Yep.
It's fairly high margin. So anytime something isn't on the shelf, you're missing out on a lot of money.
Yeah, I mean, it's that opportunity cost.
Yeah.
I mean, if it's there, if it's not. And ultimately, I mean, when you really think about it, it's they face the same challenges that other CPG companies that maybe aren't in the cosmetics or health and beauty space face, right? With service. It's not easy. They're big. They're managing, what, millions and millions and millions of freight spend?
Yeah.
I mean, do you think about how difficult it is to manage that, especially in a time, not right now. I mean, right now, like he alluded to, it's requiring that service is relatively easy, but it gets more difficult when the market shifts, and how the market was the past couple of years. So, I mean, if you haven't seen that episode yet, I'd go back and check it out, because he provided a lot of good insights around how, from a shipper's perspective, how the data, one, is changed because of experience in the industry, and how going from, I mean, he was on the 3PL side for a while, and now shifting to the shipper's perspective, how they use the data is very different, but I mean, ultimately, it's still important in their day-to-day.
Very important in their day-to-day, very important. And one thing he mentioned, he highlighted multiple times, and I think this is true, it's great advice for anybody that's in, not even just the logistics in the supply chain world, but really anywhere in the world, you know, as he said, don't let a good disaster go to waste.
Yeah.
And what he meant by that was, you know, we just came out of COVID, and there's different disasters that happen in different industries, right? You know, maybe your industry is, for whatever reason, exposed to hurricanes, right? So, you know, that's a disaster, right? There's tons of disasters out there. So in his world, don't let a good disaster go to waste, meaning there's so much momentum behind supply chain. And he was making the point that it's supply chain, it's logistics, it's our time, it's your time to get a seat at the table. Right? And, you know, you can use that momentum to say, hey, like, you know, this is something that's happened. You know, the swings are becoming more and more violent in the industry. And that's, you know, that's a great value add to say we need change in an organization.
Yeah, I mean, and he talked about his leadership, right? He's able to have conversations, and now they're interested in those conversations, right? I mean, and the other point he brought up a lot is not right or wrong, right? Is it right to do this or wrong to do this? Is it appropriate or inappropriate? And I think that's a good way to look at it, because everybody talks about right and wrong, like this, if you want to call it shipper's revenge in a market like this, or carrier's revenge when the market's like it was throughout COVID. Is it right, or is it appropriate or inappropriate to change rates, and how those discussions go? I think it's a different way of looking at it than maybe what is thought of. And I think the way he framed it in our conversation, it made sense. So.
Yeah, it made absolute sense. So very exciting to see that conversation. Hopefully we'll have more. Be sure to go online and you can get a catch up and a recap of all the different sessions from Future Supply Chain. A lot of great stuff that came there. One big announcement that we made And we're going to talk about this later in the show here today. We've launched our global ocean rate partnership. So now you'll be able to see, while a lot of folks know about FreightWaves from its ability to show real-time price reporting on trucking and even on intermodal, we're going to do the same thing for ocean. So we're going to talk about that a little bit later in the show. Not quite yet, but so stay tuned for that. But one thing I do want to highlight here today is we need to look at the diesel truck stop price. So the price of diesel, it's been going down and going down at a big pace, Tony. Look at that. Look at that chart right there.
Yeah, I mean, it's down to $3.92 a gallon. I mean, you're talking, what, a 33% decline from its peak?
Sometimes I wish I could buy puts on like a SONAR chart. Like I think that's what we need to like change this. Is we need people to be able to buy calls or shorts.
Yeah, I mean, one of the interesting things, I look at this chart and I look back.
You're just going to ignore that?
Yeah.
Okay,
kinda.
Cool. That's fine. Continue.
Hey, not financial advice. Remember that? Remember that, Luke?
Yeah.
But, I mean, I look at this and we're basically back to early 2020 levels right before Russia invaded Ukraine. If you look back 2020, look back to 2021, we've been on this like steady increase. Diesel prices have been on the rise. Like it wasn't just like Ukraine, the Russia-Ukraine.
Yeah, Ukraine didn't really kick in until early 2022.
And that's where it shot up, right?
Yeah, diesel was already on the rise.
Yeah, so I mean, we're really below what the trend line prior to that Ukraine-Russia pricing was. I think it would be beneficial to get it back. I mean, you look back, I look even further over, right? 2019, 2018, where it was right around $3 a gallon. I mean, that's 90 cents. I mean, that's still a relatively, we're talking what? Down to $1.91 in a little over a year. So, I mean, you're still talking another 7 months to get back to $3 a gallon, and the decline's going to slow down.
It is remarkable to me how long diesel was below, below $2.80 a gallon?
Yeah.
Right? It was, I mean, if you're looking at the chart, like in 2020, obviously COVID hit and all that stuff, right? And that drove prices down to like $2.60 a gallon or something ridiculous. It stayed there for 7 months before it came up. I mean, unbelievable.
Yeah.
That is so remarkable to me on this chart.
And I think it goes in, I mean, if you think about what one of the main drivers of diesel demand being truckload demand, it took a reaction in the truckload market to see prices, upward pressure on prices, right? You saw demand. If you look, it really starts kind of Q4.
Yeah.
In Q4, I mean, we were coming out of July. It was really when coming out of COVID, you saw an increase in freight demand. And by the time it crossed over like really 2019 levels, going to where it ended up in 2021, 2022, I mean, you start looking fourth quarter, it makes sense that that's where demand for trucks really picked up, and station owners were like, "Hey, let's bump our prices up a little."
So, Tony, it's time for crystal ball. How low do you think? Because this has been falling consistently for the last 18 months. Where's the floor?
I think this is the hardest part to see, because if you think about it, the rack price, that wholesale price, is really what drives the retail location price and the spread between the two. And the rack price has been really volatile. And I think it's hard to kind of adjust or figure out where the rack price is headed. Because, I mean, you can have 10, 15 cent swings overnight. And if you would have told me, I mean, even back 2021, 2020, early 2022, between $1 and $1.20, let's say, that was where that kind of comfort level for station owners, where they would hold it steady. It's very similar to where it was in 2018, about $1 to $1.20. The retail was over the wholesale price. Well, right now it's at $1.30 plus. I mean, $1.33, $1.40. So, I mean, you're talking, that's going to come down about 10 cents, but you need the rack price to kind of find a leveling off spot too, because the volatility in the rack price, it can change that spread from $1.40 to $1.25, and the station owners are like, "Hey, we're concerned. Let's keep our prices a little higher." So I think there's room for it to decline a little further, But I think it's ultimately going to stem from where does the rack price go, and how does the volatility in the rack price play out over the coming months, right? I mean, we're kind of coming, if you think about 4th of July really ends that big summer shipping season, right? That period from Memorial Day to July 4th, we're kind of coming out of that, right? Next Tuesday's 4th of July. So that's when demand really is at its strongest for diesel. So like what happens in August and September when that demand's traditionally not as strong? Because, I mean, if you think about how freight demand works, those are the two of the softer months coming off of the end of Q2 in the summer ahead of the fourth quarter.
And the freight markets buy the most amount of diesel, 25% of it, I believe.
Yeah.
This comes from the freight market.
It's 25%
of all diesel demand.
Yeah, exactly. So, I mean, it's a major component. It's the second largest expense at truckload carriers, right?
Yeah.
Behind labor. So,
and it's in most trains run on diesel.
Yep.
Right. I mean, even a lot of ocean ships, a lot of the ocean ships now run on diesel.
So yeah. So I mean, it's one of those things. As we pass kind of, it's hard to say peak season, but I mean like a stronger period traditionally for freight. You're moving into what is typically a little softer period for freight demand. What does that do to diesel demand?
Yes.
So I think there's room for this to continue to decline, but ultimately it's going to be on the rack price. That wholesale price is going to find a little stability and not be near as volatile as it has been in the past few months.
So we can expect another little bit more softening, potentially another 10, maybe 20 cents a mile. After that, it's kind of anybody's guess.
Yeah, a gallon. I'm not going a mile. You break it down a mile, it gets a little more fuzzy.
A gallon, thank you. Excuse me. So, makes sense. It'll be interesting to see. We'll keep an update on it. We'll keep you guys updated.
But it doesn't move very fast either.
It doesn't move very fast. That's right. Yeah, it's taken 18 months to fall 33%. Rates took 18 minutes.
Yeah, it feels that way. So, I mean, it's relief from a driver perspective,
right?
Especially an owner-operator where we've seen spot rates kind of find some stability, and this has fallen. It helps them ultimately. But they would like to see it fall a lot faster than what it is. But
yeah, especially the spot carriers, especially. Although the big guys, they probably like the spread between rack and retail quite a bit. Good, very helpful there. So definitely interesting. We'll keep an eye on the fuel prices, see where that goes. Potentially some further downward pressure on that. Let's go ahead here. I do want to look at the spread between truckload, spot, and contract rates because we've been looking at this. This is a chart we've kept eyes on. We haven't looked at it in a few weeks though. So this is one that, remember, the question is asked, how low does the market go, right? We've seen spot rates come up slightly, underlined word slightly.
Yeah. I mean,
barely a hiccup, but I guess you can technically say they're off their bottom. Contract rates, on the other hand, continuing to fall, which we expected, we expect those to continue to fall actually at a pretty decent clip from now, at least through August, because that's typically when the contract rates really started falling to begin with. So this chart here, I think, really outlines where we are. There's a 57 cents gap in spot line haul to contract. Traditionally, it's, about 20 cents.
Yeah, 20 to 25. I mean, you're talking pre-pandemic when really spot rates were on the floor too, right?
For reference, if anybody's looking at this chart, the red line, when it's red, that means spot rates are below contract. When it's green, spot rates are above contract.
Yeah, so obviously the end of 2020 and throughout 2021 and early 2022, there was upward pressure on contract rates. That's why you didn't see contract rates really peak out until early 2022, right? Until spot rates really started to fall. And then the rate at which spot rates declined is the reason this thing went from 45 cents basically in the end of Q4. And by this time last year, it was negative 75 cents, right? So you're talking, $1.10 swing basically?
Big money.
Yeah, I mean, it is when you're talking this is on a per mile basis.
Yeah, it's huge.
So, and the discount. And that's why I think it's interesting. A lot of the things I have heard from shippers is they didn't necessarily go and play the spot market immediately, which is intriguing because you look at this and it's like, well, we're going to get arguably we should be able to get the same service because rejection rates are on the floor. Like clearly there's too much capacity. We'll be able to find a truck and we're going to hopefully get it at a 60-cent per mile discount to what we're paying on the contract side. But you haven't seen that. And I think part of that is shippers were in a place where they were kind of, they were struggling when that number was ultimately positive, right? They weren't getting service because carriers were playing the market. But if a carrier serviced their customer during that period, that relationship and the partnership between the two was fostered, and ultimately strengthened. And I think that's why you may be seeing a little bit of a prolonged, not as much down. You haven't seen as contract rates necessarily move as fast as maybe what we thought, or as early as we thought they might move, right? Typically when you see this, when spot rates start to move, you get about 60 to 90 days before contract rates moved. It was closer to like 90 to 120 days before you started to see contract rates start to move lower. And I think some of that is these shippers were protecting the capacity that they had because they didn't want, and that may be the case overall. Like this number may stay lower than getting back to that average because they may be wanting to protect the capacity when the market does turn, right? So it's kind of this like, there's a benefit to keeping the spread wide from a shipper's perspective, but there's also advantages that they can use this for, right? They could play in the spot market on occasion and they're ultimately getting a discount versus paying a premium.
There's a lot of fear in the market still, a lot about unknowns of, I keep hearing, when's the market going to flip? The market might flip. And the quick answer is we don't expect it to flip this year, but who knows, next year is a whole other story, right? It's, and part of the reason why we don't expect it to flip this year is we're still seeing imports remain very depressed. And as imports remain depressed, that's not going to stir up increased demand for ground transportation freight in the U.S. So, as far as I think all the signals this year point towards, if we don't drop further, if nothing else, we're going to hang out here for a little while.
Yeah, and I think that's the whole point that we've talked about. We've talked a lot about it on this show. In particular, is that just because we hit a bottom or around a bottom doesn't mean we go up from here, right? We are likely to stay, there's no indication that we go higher. We can stay at these levels.
Absolutely.
There's no reason why we go up.
We looked at the fuel a second ago, right? The fuel hit a bottom at $2.50 a gallon. Diesel was at the retail pump for 6-7 months. It didn't just bump right off the bottom.
Exactly.
It's hung out there for a while. That's a long time.
Yeah.
We could be at this bottom for 6 months, a year. Who knows?
Yeah, when you look at, I think looking at spot rates is one of those things that's really interesting because if you go in and look over the past, I think it's 10 weeks, basically the second week in April till now, we've been in like a 6-cent range outside of those 2 weeks in May where we saw the rate drop down to $2.10 a mile. Then it came back, right? It was like there was almost this fear earlier in the month in May before road check week, it dropped rates. And then they realized, hey, we can push our rates up because we have road check week, end of month, Memorial Day, all within like a week and a half stretch. They pushed them up, but they pushed them back up to where they were in April. So it wasn't like they took that momentum and rode it through into June. So, and what's interesting is this is typically the best time to push rates up, right? You've got end of quarter on Friday. Yeah. July 4th on Tuesday. So there's the possibility that if you don't pick something up Friday, you may get a load on Monday, but then you have to may sit on that load till Wednesday. So, or driver may come off the road on Friday and not be back on the road until next Wednesday, right? So there's this give and take that this is the time you'd think you'd see some upward pressure on rates.
And what's wild is we've seen tender projections have barely moved. They're at like 3.6%.
Yeah, they've inched up, right? They're up
but
100 basis points in a few weeks, but it's
but it's
nothing meaningful.
I was gonna say it's from an irrelevant number at this point. So it's very low.
By
the way, do you have any plans for 4th of July?
No.
You don't have any?
Not for the 4th. I am headed to the week after the 4th.
all of a sudden got nothing to do. All of a sudden we're going to the lake, huh?
Well, it's the weekend after the 4th. It's not for the 4th.
That's fair. I feel like if you work in logistics, like you get 2 days off a year, Thanksgiving and Christmas.
Yeah.
Otherwise, enjoy. I am taking off 2 weeks after the 4th.
Me too.
So that'll be nice. 2 weeks, we can't do it at the same time, Tony. The people need to know. The people need with SONAR.
I know.
Okay? We'll figure this out. I know everybody here is freaking out, but like, we'll figure it out, okay? We'll get something. If nothing else, maybe we'll just make Tanner do it by himself.
Yeah. I'm sure he would love that.
All right, he'll be fine. He's by the way, you should all follow Tanner on Twitter. Also, you can follow me. You're giving with SONAR updates on TikTok. I'm one with the youth and with the hip and the new and all the stuff. So you should follow me on TikTok, Falasca, Luke_Falasca.
I'll let you be the social media guru because it is not for me.
Listen, I got all the updates on TikTok. Once, sometimes twice a day. So sometimes you get a 2-for-1 special. Anyways, we need to talk about one thing. So as we mentioned, Future Supply Chain was last week. We had a big update that came out. So the update, global ocean rate. So everything that we do on the trucking side, we more or less do now on the ocean side, and we do it very well. So we launched our global ocean. We've been tracking the global ocean markets from a supply and demand perspective now for a while, over a year. But we've now added pricing to that. So we've been working with some vendors there. We've got pricing data on over 3,000 port-to-port combinations. So very cool. We can pull it up here. We don't need to show it for very long. I mean, that's just kind of a quick snippet. You select the country you're shipping to and from, the port that you're shipping to and from, and it gives you everything you want to see. I pulled up a couple of high-level overviews there. I think from shipping from Israel to New York, fun fact, the price was up 190% over the last, was it a month?
Month over month,
190%. Otherwise, everything's down.
Yeah, I mean,
that's the one lane, everybody. So if you're shipping there on the ocean side, everything else is down.
Yeah, and I think that's a trend you see, right? This is great lane to lane. We were tracking it. I mean, if you start looking at what we were tracking before, right, it was more of a basket, right?
Yeah.
China to North American East or West Coast.
Europe to, North America East.
Yeah, exactly. So it's a basket. It didn't give you like, how is pricing into the Port of New York, New Jersey being affected by, because one, we can check supply demand dynamics into these ports. So now we can put the other component, that the outcome of supply and demand, right?
How is that impacting the price? How is that impacting the cost?
Exactly. So it's always, it goes back to economics 101, right? Supply and demand set the price. And now we've had supply and demand.
Yeah.
Now we get the outcome of those two. And I think it's important because you maybe could talk to this, when you talk to customers, like they're not all shipping out of they don't ship the same lanes, right?
Right.
I mean, China can be a very different, like the cost or price of shipping from China to LA is different than the price of, say, Japan or Vietnam or India.
Also depends on where from China. Are you shipping out of Shanghai? Shanghai is going to be very different from Shanghai to LA versus if you're going from, like, say, Hangzhou to Seattle.
Yep.
Very different environments there. Sometimes they align very closely and they're virtually the same. Not always. So it allows us to have a little bit more of a finite conversation around it. So very exciting there. A lot more updates to come around the ocean side. It's going to be a big investment here for SONAR as we go forward. So very excited to talk more about that on the show because there's a lot of people out there that are excited about it. You got freight forwarders. Most of these shippers are exposed to it, the financial world. So a lot happening there. Also, we got to talk about tomorrow. Two very important things happening tomorrow. First, the State of Freight webinar with Craig Fuller, our founder and CEO, and Zach Strickland, our head of market intelligence. Tune in for that. You can ask them questions. Bring your questions at 2 p.m. Eastern time. It's going to be a great time. Register at FreightWaves.com under events. So again, that is the State of Freight webinar. We do that once a month. Also happening tomorrow, very big deal.
Oh, goodness. What is it?
Me.
What are you doing?
And you. What am I doing? We have the round table.
Oh,
okay.
yeah.
So at 10 a.m. Eastern time on FreightWaves TV or tv.freightwaves.com, you can come see moi and of course Tony and others on FreightWaves now, and we will be reviewing and hosting a roundtable, a very exciting roundtable because we will be looking at some of our predictions from back in January and seeing how right I am and how wrong you are.
Hey. I'll give you all the credit in the world. How right you are.
We're just gonna edit it to make sure it's accordingly.
Yep.
So yeah, it's like whether I'm right or not, it's like I'm gonna be right. No, I'm just kidding.
And hey, it might be your first time on FreightWaves now.
Not my first time on FreightWaves. Now my first. I've taken about a 2-year hiatus.
Okay, so first time since we've done the rebranding.
Yeah. First time since we've done the rebrand. It's been actually it might be more than 2 years to be honest. I was like back in we don't need to
one
go
of the
into
OGs.
It. Anyways, folks, thanks for tuning in. That's all we have time for today on With Sonar. We will see you live next week, Wednesday, the day after the 4th of July. In the meantime, have a fantastic rest of your day. Remember, tomorrow, FreightWaves Now, 10 a.m. We'll see you there.